A merchandising business sells goods to its customers and needs to buy those goods from another company to then resell them. Accountants must understand how to record purchases, returns, and allowances and discounts, which differs depending on what inventory system is used, the periodic inventory system or the perpetual inventory system. In this video, I'll talk about the inventory systems and how accountants record purchases and the related freight costs. Merchandising companies use a system to manage their inventory, and there are two types of inventory management systems: the periodic inventory system and the perpetual inventory system. Small businesses often use a periodic inventory management system, and like the name indicates, it means that inventory is only taken periodically, such as once a year, once a month, or more frequently. All purchases of goods are recorded to the purchase account, and the inventory account on the balance sheet is only adjusted when the inventory is counted. Outside of that inventory count, the business doesn't really know exactly how much of a specific item it has on the shelves without physically counting the inventory. If the business only sells a few items, it's easy to tell whether the inventory is low, but as the business grows, it becomes more difficult. That is why growing and large businesses use the perpetual inventory system, which tracks the inventory with every purchase and every sale and return. For instance, large retailers like Walmart use perpetual inventory systems, and the moment an item is sold, the inventory system subtracts the quantity from the inventory balance. Walmart's vendors can access Walmart's inventory system and see whether item inventories are low and new goods need to be delivered. It is a very efficient way to manage inventory. Purchases of merchandise for a company that uses the perpetual inventory method are first recorded to the inventory account on the balance sheet. And then when a sale occurs, the cost of that sale is debited to the cost of goods sold and credited to the inventory account. The purchase of merchandise for resale is a cost of doing business, and accountants use the purchase returns and allowances, purchase discounts, and freight in or transportation in accounts to track those purchases. The purchases account and the freight in account are expense accounts with a normal debit balance. The purchases, returns, and allowances and the purchase discounts are contra expense accounts with a normal credit balance. All these accounts are part of cost of goods sold, a separate section on the income statement that shows the actual cost to the business of the merchandise sold to customers. Freight and transportation charges can be a significant part of the cost of buying merchandise for resale. That is why an important topic is who pays for these charges. There are several different shipping terms that you should be familiar with, especially in international trade. These shipping terms are called Incoterms, and the most common terms are EXW, FOB, CIF, and CFR, and DDP and DAP. They basically explain up to what point in the shipping process the seller pays the cost and from what point on the buyer is responsible. I've posted a shipping term video on Canvas that provides additional information. Our book only mentions the FOB term, which means that our examples only mention the FOB terms rather than any of the other terms. So let's talk a little bit more about FOB. When you buy products online, you typically pay for the cost of shipping. In business terms, that is called free on board or FOB. That means the selling company will bring the goods to their loading dock, but from that point, the buyer pays all costs. From a legal perspective, it also means that from that point, the product belongs to the buyer, and if there's any damage en route to the buyer, it's the buyer's risk. There are circumstances where the seller pays the freight charges up to the buyer's loading dock, and those terms are called FOB destination. If the buyer is responsible for the freight charges, the buyer may have to pay the transportation company, or the seller pays for it, and includes it on the invoice. So let's look at an invoice and see how those freight terms and other information is shown on that document. And after all, the accountant spent some time reviewing invoices to determine how to properly record the business transaction. This is the invoice maxx-out sporting goods received from Modern Sportsman for the purchase of men's compression t-shirts and shorts. At the top of the invoice is the name and address of the selling company, and in the upper right-hand corner is the invoice number. In the next section, we see the name and address of the buying company. In this case, the billed to and shipped to address is the same, but for many companies, the billing and shipping address will be different. If maxx-out had multiple locations, the invoice should be sent to the accounting location, not to the individual store. To the right of the buyer's name and address are the invoice date, the purchase order number, the shipping company used, which is Speedy Express, and the payment terms of net 30. In the next section, we see the order number again. The salesperson field is now populated. The payment terms, the date shipped, which is a day before it was invoiced, the shipping company, and then we see FOB Tustin. Tustin is where Modern Sportsman is located. Next, we see the quantity ordered of 10, the description of the product, the unit price of $476, and then the total price. And since the shipping terms are FOB Tustin, the buyer pays for the freight charges of $360, which then brings the total price to $5,120. So what does the accountant do next? Accountants record the invoice once the three-way match is performed. Do you recall what that is? That's right. The accountant matches the purchase order to the receiving document and the invoice. If all agree, the invoice can be recorded. maxx-out Sporting Goods uses the periodic inventory system, which determines how accountants record the purchase. Under the periodic inventory system, all purchases are immediately recorded as an expense, and only after the inventory determines how much inventory is in stock or on the shelves will the accountant make an adjusting entry to move some of the cost to the balance sheet. Let's analyze this purchase now. Purchases increased, purchases are an expense, and expenses increase with a debit, so we need to debit purchases. Freight in also increased. Freight in is also an expense, and they increase with debits, so we debit freight in. The invoice has net 30-day payment terms, which means the company has now more accounts payable. Accounts payable are liability, and liabilities increase with credits. Therefore, a credit to accounts payable. We start by writing the date into the date column and the account purchases in the description column. The cost of the shorts is recorded in the purchases account, and the shipping charges are recorded in the freight in account. That is why we debit the account purchases for $4,760. On the next line, we write freight into the description and debit that account for $360. On the third line, we slightly indent and write the accounts payable account into the description column and $5,120 into the credit column since the payment terms are net 30 days. This is the process for recording purchases for resale. When you purchase other goods that the business uses, like office supplies, office equipment, or software, basically goods not for resale, the freight charges are an integral part of the purchase and not separated from the cost of the product. When the payment is due, we analyze the transaction and find that accounts payable decrease, which is a liability account, and according to the dealer mnemonic, liabilities decrease with debits. So we need to debit accounts payable. Next, we find that cash also decreased. Cash is an asset, and assets decrease with credits, so we need to credit cash. And we're ready to record the journal entry by writing the date into the date column and a debit to accounts payable and a credit to cash for $5,120. Here's another example of an inventory purchase for Lens Queen Shop, a retail store that sells cameras and photography supplies. On April 3rd, 2024, the business purchased camera accessories on credit from Vision Supplies with invoice 825 for $1,025, terms net 30 with freight of $25, prepaid by Vision Supplies and added to the invoice, total amount due $1,050. In this case, purchases and freight increase. Both of these accounts are expense accounts that increase with debits. So we debit purchases for $1,025 and freight in for $25. Accounts payable also increased. Accounts payable are liabilities, and liabilities increase with credits. So we credit accounts payable for $1,050. On April 3rd, 2024, the business purchased lenses on credit for $960 from Lens Nation Incorporated with invoice 998, terms net 30. In this case, purchases increased, which is an expense account that increases with debits, so we debit purchases for $960. Accounts payable also increased. Accounts payable are liabilities, and liabilities increase with credit, so we credit accounts payable for $960. I hope this video helped you to understand the journal entries for resale purchases and the important shipping terms. In the next video, we'll cover purchase returns and allowances, how purchase discounts are recorded, and how the accounts payable subledger helps the business keep its vendor liabilities organized.